No on that.
I'd have to pass. I'll go with chocolate or vanilla.
I hear you. But he came in today to talk about your mortgage, Carl Delmont from Fremont Mortgage. And you always give out great advice. People always have questions. So let's get right to it, because we have a question this morning from Francine in Pasadena. She says, I put an offer into a home that was short sale, but 3 weeks later, my agent said the information was lost. He had to start again. But my lender said that the rate is about to expire. Is buying a short sale a mistake? Can you help Francine out?
It's not a mistake, but I think you have to go in understanding the distinctions between a short sale and any other type of transaction. For instance, if you buy a foreclosed home from a bank, the bank actually holds title to the property, and they can negotiate the price. If I buy a house from you, you own title to the property. You can negotiate the price. But if you're buying a short sale, say I buy your house at short sale, you still hold title to the property, but the bank negotiates the price. And then it's complicated further. Let's say there's a second and a third mortgage on there. Then those two entities have to agree to accept less money than what you owe on a property. So it's a little bit complicated. And in this instance, my guess is there's one software system called Equator, and that's what everyone uses to go with the banks for the short sales. If you don't upload everything the bank requires in 14 days, it disappears. So that's probably what happened in this case. And most people do lock them 30 days, so that's probably the lender saying, well, if you're going to start all over again, rate's no good. So you got to pick an experienced realtor and make sure the house is already pre-approved for the short sale. The bank's already agreed on a price and everything else. That's a big distinction.
You know, we've heard so much about short sales, but you've always said just be careful, know what you're getting into, and do your research.
You can get a good deal. It's just, again, there's a little more work involved, and it's a little bit different animal than the regular transaction.
Okay. All right. Well, our next question comes from Sheila. She says, I'm divorced after 17 years of marriage, and I am buying a townhome for $210,000 and received $150,000 from the sale of my marital home. I'm really uncomfortable with a payment of $1,100 a month with my monthly income. Is it wise to put down $100,000? What do you have to say to Sheila?
I see this a lot with people going through a divorce, especially if you've been out of the workforce for a while and you get this lump sum of money. So I think this is the time where you bring your financial planner, your CPA in with your mortgage professional and work on this and look at the different options. But here's an example I would tell people. In this example, if she did $210,000 and put the least amount of money down, her payment would be about $450 more, including the mortgage insurance, than if she put $100,000 down. So what she can do is she can actually put less money down, and then what she can do is make a payment. Say she takes the same $100,000 she was going to put into the bank. All she has to do is make the payment to, say, $500 to, say, another bank, a credit union, or a checking account, and then have that money taken out. So she pays $500 a month to her mortgage or her credit union, and then has the mortgage company take out $1,000 a month because she put a little bit more, she put the money down. So there's another way to keep your money and still in her mind make the same low payment she wanted to make. Okay. But again, you have to look at the opportunity cost of the money. Are you better off having less money and have a lot of equity in the property, or are you better off having putting more money down? And so you got to look at both of them. But there's ways to skin that cat.
Okay.
I didn't probably explain that too well, but
no. It does make sense, but it is one of those things where you probably want to talk to somebody who's experienced.
Exactly.
Okay. All right. Hope we helped you guys out. In the meantime, you said before we go we have a tip.
Yeah,
the IRS.
Good news from the IRS.
Right.
The IRS came out recently, and they said if you have a tax lien, an IRS tax lien that you have paid, they will now consider removing it from your credit bureau as long as it's paid and as long as the taxpayer initiates the call. So if you had a past deal where you owed the IRS money with the tax lien, that's going to hurt your credit score, hurt your chances of getting a loan. Well, if you've actually paid it, have proof you paid it, and you, the taxpayer, call the IRS, they will actually remove that from the credit bureau, which is a good thing.
All right, Carl Delmont from Fremont Mortgage. Just remember, if you have questions, you can email us morningshow@wmar.com. Always good to see you. Thank you for coming in. Charlie.